is their chief global economist, Oganes, as well as Sunil Garg, of course, very familiar for us. Every time we have some jitter in the markets, we run to Sunil Garg for advice, and we have the big man from the equities as well with us. Gentlemen, thank you very much for finding time from what has been a busy set of back-to-back meetings that you all have been addressing. Let me start with you, Louis. We continue to get these jitters of the Fed hike or Brexit, but all those have been buying opportunities, and yet we have negative interest rates. It's not as if we have very good economic data. Are we going to have some kind of a meltdown because of this? Economic data not really looking good at all. As well, equity markets doing very well. Do you think that one of these jitters will actually be a serious crackdown?
I don't think that there will be a serious crackdown. I think that the healing process in EM fundamentals, meaning the recovery of growth, we're not painting here a very bullish growth outlook, but at least a stability compared to 3-4 years of constant deceleration. That I think is a change in, is a dramatic change in the backdrop for investment in emerging markets. There's going to be jitters coming from G3 central banks. We have a meeting by the BOJ next week. We have the Fed as well. I just don't think that the volatility coming from there will be volatility for sure. I think that the mindset of investors at this stage is to use that, as you say, as a buying opportunity, as opposed to a reason to sell, pack and go. I think that there's a case to stay here because of the stability of EM fundamentals.
Okay. You're speaking about EM fundamentals. What would be your pecking order in terms of economic growth? We have seen this fancy for China from the equity space, but as growth areas, what are your favored EM markets?
Well, what you're seeing right now is that EM, the projection that we have for EM as a whole is for 3.6% growth in 2016. If you look at developed market growth, we're looking at only 1.6%, so a differential of 200 basis points EM minus DM. Okay. That differential used to be 300-400 basis points in the good years, when China was growing at 8-10%. So we're not there. We're not there right now, and we won't get back, to where we were before. So, however, we think that we have reached a trough, and going forward, that growth differential is going to start favoring emerging markets, and that's why we're going to continue probably to see capital flows coming back in. India is the country that is the fastest growing in emerging markets at this stage. It's actually outpacing China, which is interesting. All these better dynamics for EM growth is actually happening despite the deceleration that we're seeing in a manageable fashion, I would say, in China. The countries that are recovering from recession, like Brazil, like Russia, other countries that are big commodity exporters, these are the countries that are now attracting a lot of inflows. So India is doing so on the equity side in particular because it is the fastest growing economy in the world these days. But we have others in emerging markets that are coming back from the debt from the previous years.
Okay, well, I want to get to Sunil on this issue. Just before we spoke to Louis, we were discussing the Indian dynamics with a Nomura economist, and she was correctly pointing out that consumption growth is still tepid by Indian standards. Capex is non-existent. Public capex is happening, but not too good. What are your bets on India as a stock market investor? Valuations high, growth still not really what one would expect, whether you look at IIP or you look at capex.
Yeah, I think, Lata, one of the big changes I would say in the current rally, and if I go back over the last couple of years, we've had a lot of false starts. We start the year with a 16-17% EPS growth, and by the time we end the year, it's been cut down to low single digits. I think we're seeing the market on a much stronger footing right now, and I think there's greater confidence that we have in the earnings trajectory as we go from here. So we're looking 16-17%, feeling a lot more confident about the earnings trajectory. No doubt, valuations 18 times forward are already pricing some of that in, but I think the earnings based trajectory is a lot better. I think the Reserve Bank has been a lot more accommodative, and we do think that that accommodation continues. So I think that definitely helps. I think at this point in time, we've been very much in favor in the past of playing a defensive game in healthcare and IT. At this point in time, we are actually underweight those sectors, and I think financials are the place to be. particularly as you start a new credit cycle, I think that would be where you'd get the most leverage return. So I think our sectoral allocation is very much is reflecting the confidence that we have in the earnings trajectory at this time.
Okay, I will come back to your sectoral preferences in a minute, but first let me thresh out the theme that I started off with, Louis. This jitters from global markets. Ultimately, the emerging markets also move only when globally risk is on, risk appetite is on. Do you see the flows coming into emerging markets remaining, good, or do you think there can be some major shocks?
So a couple of things we need to consider here, right? To start with, I think let's take the context that emerging markets, equities at least, have been underperforming for a period of 5 years. So the outperformance that we've seen this year in the context of this 5 years of underperformance is very nascent. And I think I've said this on this show many times in the past, our biggest issue has been the earnings trajectory in the emerging markets has been disappointing. Our expectation is this accelerates here onwards from 7% this year to 13% next year. And there's been a very large drag of PPI deflation across the board. I think as that ends and that becomes supportive, I think China is a real case in point, then I think you have a much stronger footing. So I think we're feeling definitely very strong about the emerging markets outperformance. But even more broadly, it's almost like a Goldilocks setup where you have real interest rates in emerging markets which are coming down, the PPI drag is ending, and if you look at even the global growth estimates, our GDP estimates have now been up 2 months back to back. So there's definitely a confidence about the growth trajectory almost on a global basis. And yes, your earlier question about could there be complacency leading to a big drop? We think the environment is very supportive. Obviously, there are a few things we need to think of, but I think at this point in time, for example, we're not even looking at any hikes. Of course, next week's meeting, the probabilities have dropped to almost nothing.
Okay. No, I'll come back to just one more question on this emerging market hubris, if you please. This big jump that we saw in emerging market, into emerging market flows was probably explained by the rock bottom prices that commodities touched in December, this big devaluation shock or fear of a devaluation from China. Commodities have moved a goodish bit from there, and after that steel, iron ore, coal and crude are all finding roofs. Crude at 50, 51 perhaps, likewise for iron ore. I mean, is there a fear that this emerging market play has played out? You don't worry that?
So I think, look, short term you'll get, things go up vertically. Iron ore is a very good example. You saw very big 25-30% spike. The same thing happened in crude. So things will consolidate, come off, which is really where, again, the comment about the Goldilocks comes in, that it isn't overheating. And again, in the context of how much we've fallen, I do think it's still very early days in the emerging market outperformance. And just a comment on the flows itself. Most of the flows we've seen are still very ETF driven, which is asset allocation. We still think that the positioning is underweight the emerging markets. So there is definitely, as conviction builds up and price builds conviction on its own, then you will start to see more flows coming in. So that's why there's a lot more confidence in this particular outperformance and this emerging market trajectory we're seeing at the moment.
You agree, Louis?
I would agree with that, and let me just put some numbers to illustrate the point. We have seen year to date around $45 billion of inflows into a combined emerging markets fixed income, which are around $33 billion, and equities $12 billion of inflows. This number, even though it looks large, it comes on the backdrop of almost $79 billion of outflows just last year, and almost $20 billion of outflows in the previous 2 years. So the size of inflows this year is not that it has taken investors around the world to be overweight emerging markets. As Sunil points out, we're playing catch up here. Investors, I think, still feel that are lightly positioned in emerging markets. Maybe in the best case is neutral, not overweight. So we don't think that despite this rates volatility we're seeing in the core markets, that this is going to undo the the more benign dynamics that we have seen year to date in flows.
Okay. Well, that was a lot of questions on the global scenario, and you make me feel confident that the world risk flows will be benign to emerging markets and to India, but we have a lot more questions on what you have gleaned from the Indian policy makers over the last 24 hours. We have to take a mandatory break at 10 o'clock. We are coming back in a jiffy with lots more questions to our guests from JP Morgan.